Good morning, traders and investors. It is August 5th. We got the market starting to move. We got some interesting price action unfolding. Yesterday, members, we got a sell signal to exit our QQQ, or more so our QLD trade today at the opening bell, which is going to work out very nicely. I'm going to cover kind of the sentiment flow, but long story short, our QLD trade from our entry price is up over 32% this morning at the open. And we'll be closing that out. Now, sentiment, the tide is turning. There's some pretty interesting things starting to unfold. Let's jump into the short-term price action of what we've seen and where I think yesterday's bounce in this bar is going to be. Yesterday's bounce is probably going to have most people feeling really bullish. They're expecting the markets to go higher. And we're doing the exact opposite. Yesterday was a FOMO day, so our FOMO indicator, which I show in my book, Technical Trading Mastery, how to set this up, how to use it. When we have FOMO, that means everybody's piling in. And I saw this with our inbox indicator, the comments coming in from people saying, how are we having a trend change in the NASDAQ on such a strong day? And part of that is, well, we don't look at the current day for analysis. The current day is pure reactionary. It is just what's going on now. It's a reaction. Yesterday was a FOMO day. We look what's been happening for the last several weeks, and more or less the momentum and everything has to shift. There's a lot more than just the current day's price action. And yesterday created FOMO. Everybody's bought in yesterday. They didn't care what price they bought into the market. And I was saying yesterday in the afternoon update saying, we'll probably see the market's gap higher today because the people who were working and didn't get in yesterday are going to have FOMO, and they're going to put in a buy order and drive the market up in pre-market, and we're going to open higher. And we are set to open anywhere from almost 0.6% to 0.5% higher. And what could very much so happen here is the market gaps higher. Everybody, the last people who didn't get in from yesterday, the very short-term traders, they buy at the high, and then the market sells off, fills the gap, and potentially goes down in a bigger way. Now, believe it or not, this scenario that's unfolding right here is actually very similar to this scenario right here. Now, the market could just push to all-time highs. Nobody knows, but our analysis is saying close position, lock in the profits, and wait for a fresh new setup to get back into the equities. And we're going to move our money elsewhere to protect it and just make sure we don't give back any more gains than we have to. And that's kind of where we are from that perspective. Now, a few things did come into play. So we had the previous day, we had the market close with panic selling, which typically means if we have panic selling, it's kind of the opposite of FOMO. If everybody's dumping shares, short-term traders, they've driven the market down, they've exited, usually the market's going to bounce. So not only that, but we had this lime green area. This is an oversold market condition saying, hey, the market is oversold. It should have a bounce when we're in an uptrend. So we had oversold, which again is an indicator I share in the book. And we have the panic selling, and that told us yesterday we're probably going to see a bounce in some type of move higher, which we got. If we actually look at the put-call ratio back on this day, this sell-off day, when people were dumping shares, we saw the put-call ratio. It doesn't look like much, but it gapped up higher and moved up. People started buying put options. People quickly went from being super bullish, buying calls, leveraging themselves, thinking the market's going higher, to one day they flip and they're like all buying put options, betting on the falling market. When people are betting on a falling market, usually it goes the opposite way. And so that's kind of what, that little scenario that has unfolded. And if we go back to the S&P 500 here, and I pull up our short-term cycle indicator, you can see when we have the lime green are stronger cycle lows. These are much shorter cycle lows in the market, and we just had another lime green cycle low. So these are very short-term cycles. It only means the market has to bounce for one day. Again, this short-term cycle analysis goes more or less with the 30-minute chart. But we had that cycle low on this close. It carried over yesterday, and the market is trying to bounce for just a short-term bounce, which is what we had yesterday already. So a lot of things kind of lined up for that. Now, let's take a quick look at the sentiment chart. If we look at the sentiment chart of it doesn't matter if it's the SPY or the QQQ, which is our gauge for the NASDAQ here. If we go back, we'll just go to the SPY. If we go back here and we take a look at our sentiment chart on the right, these deep red bars I mentioned yesterday in the video saying, hey, there's definitely some change going on. This means there's more so I said yesterday, blood in the streets. That's why they're deep red. People are worried. They're starting to, people who literally bought recently are under pressure. There's some big institutional selling, some big volume selling going on, a lot of things behind the scenes. This can lead to, obviously, like the big sell-off we had earlier this year. So there is a bit of a shift going on behind the scenes. Even though yesterday's stock market moved higher, we still saw things breaking down behind the scenes. And that's what the stock market does. It does camouflage. This big rally day has most people thinking the markets are going higher, has them very bullish. They're going to pile in today at the open and probably pay a higher price, only for the markets to collapse and fall and go down. And then they'll eventually shake out and take a loss. So sentiment is definitely giving us a warning as well that things are changing underneath the hood of the markets. Now, we had a member wondering, what do we do with our with other positions that people have? A lot of people are, one of the members said semiconductors. And I think that same member has semiconductors. They have the SOXL ETF, which I think is the semiconductor stocks. It's just large caps or something. I'm not sure. They also have Tech L, which is another tech. I do want to mention something here. If you have semiconductors, I'm just going to pull it up on this chart here. Let's just take a look at this. SMH, this is where so many people go wrong, especially when you fall in love with a sector like uranium or precious metals, and miners and stuff like that. This is where most people really fall into this problem. If we take a look at semiconductors there, let's insert a symbol. This person also has SOXL, which is, get rid of some of these other indicators. This is the semiconductor bull 3X. So it's the same thing, just with more leverage. And they also want to know about the Tech L. Let's see what this symbol is. This is the technology long. Now, if you notice, we could just move in. If you zoom in, they're all the same. These all move the same, give or take a percentage difference here and there. Obviously, 3X will move roughly 3 times as much. But I know a lot of people that do this. They get into semiconductors and they buy the SOXL and then they buy the Tech L. They buy like a gold mining stock and they buy a whole bunch of gold mining stocks and different ETFs. The silver miners, the gold miners, all of that stuff. They're all the same trade. When it backfires, you blow up your account. And that is the problem. People, you don't just layer in different ETFs and stocks in the same sector. You pick one or two that are similar, make sure you have proper position sizing. You don't just buy a whole bunch of the same things. All of these are going to tank at the same time. So just be aware of that. Now, the question was, do you get rid of, close out other positions now that we have a sell signal on the NASDAQ? And the answer is yes. If you have any stocks or sectors, this is what we do with our band strategy. Is when the NASDAQ, which is powered by the QQQ or the NASDAQ, when it has a sell signal, a trend exit, which we have for today, today at the open, technically you should close out all positions, all stocks. You don't want to hold stocks other than the SPY. We are still long the SPY. It is up pretty nicely here. Actually, we're not long the SPY. We closed that with our ACS strategy. We're long SSO with our band strategy. And it's up fairly nicely. It'll be up over 23% this morning. We stay long the SSO, but if you have any other stocks or sectors, we close them out. They're all based on the QQQ. Growth stocks and sectors move faster. We time that with the NASDAQ going forward. So that is kind of the move out of the markets. Something bad could potentially happen, and it's about protecting our capital and then being able to reload. And that's exactly what we did back over here. The market gave us a sell signal. It only pulled back really like 3 or 4 days, and our strategy said get out, and then the market collapsed. And we're having a similar type of setup right here. In fact, the long-term chart, when we look at the long-term investing trend, this is the weekly chart of the S&P 500. What we have going on under the hood right here is almost identical to what happened over here as well. Now, we had that over here, and these two were the same type of setup. And now, again, it's the same type of setup. We did go into a 20% correction there. And again, we could potentially see something pretty big happen. Whether it happens or not, it doesn't matter. It's not about me calling the direction and nailing it. It's about us trading the trends and changing gears and changing direction when we need to. And that's what I think a lot of people get confused is they want me to make a call and be right. And when I'm not, I take the heat. But really, it's not about me being right. It's about how do we follow price? How do we manage positions? And I can be wrong almost every trade with my opinion, but we still nail it with the strategy and make money. And that's where people need to differentiate. Don't listen. Don't trade what you hear. Let's trade what the charts tell us to do. I'm constantly warning of fear of the markets could correct because you need to protect your capital. And if I just say, go buy all this stuff and buy like everyone else, eventually you're going to lose a ton of money. So I'm always about protection. And as long as we have a plan to protect us on the way down, even if the markets don't go down, it doesn't matter. At least we have a plan to execute if it happens. And so that's kind of where we are right now is the NASDAQ has moved us out. You can even see the semiconductor space. It's bounced from oversold condition and has had a nice bounce. But overall, the markets are going to gap higher today with FOMO, I think. We could potentially see it sell off in the stock market in general, and it could head a whole lot lower, or maybe it wants to grind up a little bit for another session or two, and it could roll over. Either way, there is a pretty big sentiment shift happening behind the scenes. In fact, just look at the volume. It really ramped up on this little sell-off here in these past couple of days. If we just zoom back in time, we had a big ramp up in red bars over here. On that breakdown, we had a ramp up in bars over here before it had a bigger washout and sell-off. We never know if it's going to be a 3%, a 8%, a 20%, or a 50% multi-year correction. We always have to protect ourselves every time the market rolls over. And that's our whole focus. And then we just get back in when the trend turns back up. So let's just look at the rest of the market. What is happening from a high level view? All the indices are moving higher today. Money's going into stocks. Money is coming out of bonds and gold, the two somewhat defensive plays. We're seeing bonds have a very small pullback. They're really just kind of trying to figure out what's going on there. Gold has had a pretty nice pop recently with the fear starting to build. It's right up at resistance. It's having a little bit of a pullback as it runs into some overhead resistance here. It is very close to having a pop and break. We talked about this with the comparison of 2007. Here are the two charts. This one here is 2007. You can see down at the bottom, the stock market put in a high. It pushed to a nominal new high while gold was running up. As the stock market started to sell off, as we just scroll forward, you can see gold continues to run and shoot higher for that final big push higher. And I believe that's where we could be headed. We have on right now the stock market, we've hit this new high. Market's starting to roll over, gold's starting to run. We could see the stock market sell off in a big way, and gold shoots up to 4,100 an ounce US. That is our next upside projected target based on the gold chart. And so that's kind of what we're looking for. Eventually gold will sell off. You'll see eventually it does peak out, and when there's enough selling in the stock market itself, it will pull gold down with it. So this is a trade more or less in gold. If we do see a breakout on gold to the upside, it has a nice percentage run. It's like 15%, I think, to the upside. Well, the stock market potentially flounders and sells off potentially in a pretty big way. It could drop another 20% while gold goes up 15 or 20%. So anyway, the charts are telling us that, gold's warning us that things are starting to set up very similar to a pre-financial crisis setup, and whatever, probably tariffs will be blamed for the crash, but who knows? It doesn't really matter. Every bear market is from the same thing. It's from people fearful of whatever is happening, and they dump shares and they sell. It doesn't matter the scenario. Let's take a really quick look at the US dollar, Canadian dollar exchange. I know a lot of us are Canadian, and more or less, it's got up. We've seen the exchange get way up here, this 146 level, several times. Each time it's been hit pretty hard. It has been hit hard again. We do have this kind of support zone that it has settled down into. And when we zoom in on that chart, I am still bullish on the dollar. Most people are very bearish, which is good. Generally, I don't want to be with the herd mentality and thinking like they do. So this is the scenario here. Feels like we're trying to carve out a bottom. In fact, if we zoom in a little bit more, we have what I call an impulse move. If we were to draw on the chart, an impulse move means we have a move up that breaks two previous highs. We have one high right here. We have another standout high over here. In fact, we even broke this one here. We broke this standout high as well. So we busted through 3 layers of resistance, meaning there was enough upward movement that it cleared through resistance. And after you break through those, usually the first pause and pullback can become an opportunity, a buying point where it'll have the next leg up and then figure itself out and then the next leg. So it does feel like we're carving out a very short-term, stage 4 decline, a mini stage 1. It feels like it's now, I would like to see it really break this level over here still, but it is showing signs that we have carved out a bottom and we are headed upward. Right now, it's just in a pause mode. And so holding US dollars, if you're Canadian, is a good play at this point. This has potential for a pretty big move. And if we go to the monthly chart, you can see the projected upside here. I don't think this chart goes that far back. Upside projection. I mean, if this was to totally blow up in a huge crisis, which I think we're on the cusp of, we could see this exchange go to $1.73. So holding US dollars is a very lucrative play percentage-wise. That's a big potential move. Even if it just goes back up to this level, 153, the golden ratio of 618 extension, it'll be a huge, nice boost as well. Anyways, other than that, I think that is it